Hey everybody, we are going to talk about one stock that has been on toward the top of my watch list lately. It is Airbnb. Before we dive in, take a minute and check out the link you see on your screen, fool.com/Frankel. Get a message from my sponsor, The Motley Fool. Get the top 10 stocks to buy right now and a lot of other interesting investing content. It's the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel. So let's dive right in. On the surface, Airbnb's recent results look pretty good. Let me share my screen real quick. All right, so just to kind of run through these real quick, revenue is still growing by double digits year over year. That was better than expected in the second quarter, and this is a highly profitable company. 20% net margin, 41% free cash flow margin over the past 4 quarters. It generated $1 billion of free cash flow just in the second quarter of this year. The company is doing a great job of returning that capital to shareholders through buybacks. Um, the share count's down by 2% year over year, even with the effects of stock-based compensation diluting shares. It more than offset that. Another $6 billion authorized to buy back shares. The company has over $11 billion of cash and equivalents on its balance sheet, and that's in addition to more than $10 billion of funds that it is holding for hosts. So it beat expectations, both the top and bottom lines. It's growing nicely. So it might seem odd when you see this chart that Airbnb stock has kind of, it fell off a cliff after those earnings. The earnings were right around here. You can see the stock just really took a nosedive after earnings. And the reason for that, let me go back to this, is the company's forecast for the next quarter. So let me see if I can get that real quick. May make this stuff a little tough to find. Okay, there we go. So in the third quarter, Airbnb is expecting growth to slow down a little bit. Year over year growth rate of 8 to 10% is expected in terms of revenue. Remember, it was 11% year over year in the second quarter. So not terrible. That alone isn't enough to really tank the stock. The big part is this paragraph right here. During the third quarter, they expect a sequential moderation in the year over year growth of nights and experiences booked relative to the second quarter. Latin America and Asia Pacific are still strong, but, and here's the key sentence, however, we are seeing shorter booking lead times globally and some signs of slowing demand from U.S. guests. So they're seeing demand slow down in the U.S. That really spooked investors and is really why the stock, fell off a cliff like it did. Lastly, we expect ADR, which is the average daily rate, to increase modestly on a year-over-year basis in the third quarter. So it seems like that was a little bit harsher than expected in terms of the wording. Seeing shorter lead times from in the U.S. and slowing demand from U.S. guests. Travel has been very, very strong since the end of the COVID pandemic restrictions. There was a lot of pent up demand for travel. We saw that come through the market, especially in 2022 and into 2023. It was definitely one of the more resilient parts of the U.S. economy in recent years, and it looks like things are starting to slow down. Now, you can make a bunch of different arguments why that is. Maybe everyone's pent up demand is just kind of exhausted at this point. It could be due to economic uncertainty. There are still fears of a recession, rising interest rates. People aren't as willing to borrow money these days. People would fund. I mean, back in the days of 3% mortgage rates, people were doing cash out refinances on their houses and using some of the proceeds toward vacations and things like that to get experiences, and that's not really happening right now. Not that using your home equity for a vacation is a good idea, but it was happening, definitely to a greater extent than it is now. So a couple of caveats, and you can see right here that the stock has rebounded a little bit lately. So the reason for the things to keep in mind when you read what Airbnb wrote in that letter, that was before recent inflation data and the Fed's rate cut happened. We got some really positive inflation data that made it kind of clear that the Fed was going to cut rates in September. We saw a better than expected rate cut, which is really when you see this spike over here. So it's rebounded about 10% from the initial post earnings fall due to lower rates. Lower rates could have a few different effects on Airbnb. Some could be bad, some could be good. Um, I mentioned Airbnb has about $11 billion in cash, plus another $10 billion it's holding on behalf of its hosts. Um, it makes interest income on that, and lower interest rates mean lower interest income on that. That's a relatively minor problem. Um, what the bigger issue is that a more aggressive Fed rate cutting cycle could lead to the soft landing in the economy that everyone's been looking for, that we aren't so sure that was going to happen. Um, I saw a report yesterday that some investment bankers think that the 50 basis point rate cut really clears the way for the soft landing. That could be, and lower borrowing rates, things like that. Like all these could be positive catalysts for travel demand. If consumers are confident that the economy is going to be strong, they're more likely to spend money than if they think the economy is really in trouble. Um, so it looks like things might be turning around. I think the valuation is right on this. As you can see, Airbnb is still down about 22% over the past 6 months, even though the business continues to grow. It trades for about 30 times forward earnings, which is on the lower end of the recent history for this company. It's not a cheap stock by any means. It's got about an $82 billion market cap. It's one that I'm watching closely. I'm not sure that I would use the term bargain here, but it definitely looks like it is a fairly valued company, especially below that, fall with the stock price significantly below the highs. I think it's an attractive opportunity going forward, especially if you believe, like I do, that the Fed is going to be able to pull off that economic soft landing, and the economy will be able to avoid a recession, which should help keep travel demand high. I'd love to know what you think. I'll do my best to respond to any questions or comments you have individually. Do you like Airbnb? Do you think it's a good buy right now? Would love to hear what you have to say. And until next time, thank you for listening. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.